Hello and welcome to Module 3 of the Options Income Masterclass. In this video, what we're going to be doing is discussing the two main applications for trading call options. We're going to try to keep things simple, direct, and to the point. We could certainly cover a lot more theory and material. Is that really necessary for creating income? I would say no. So we're going to stick to what we need to. And then we're going to discuss the challenges and liabilities inherent to these strategies and kind of offer you a little bit of direction for that. The text for Module 3 goes into much more of the theory of leveraging call options as an asset proxy, or using the option to control a specific quantity of the asset's gains and losses. This is very commonly the definition that you'll hear for an option. An option gives you the right to control the gains. The thing is that nobody really uses an option to control a larger portion of the underlying. That's more of a real estate play. That's more of an institutional play for somebody that's got a ton of capital. Larger institutions will sometimes use call options to control the gains on large chunks of assets as a longer term leverage play. But retail, like you and I, just doesn't have the capital to play this game. So retail trades call options. We buy them, we sell them, and we don't hold them generally until expiration with the idea to control something. We trade them to be able to either create income or leverage gains. So we trade them long and short, and that will be the focus of this video for Module 3. Let's get into our first and most obvious setup, which is trading long call options. We know that long call options gain value as the price of the underlying asset goes higher. They're a long delta instrument. If your option chain happens to show deltas, you'll see a positive number in front of that. That means that as the underlying price of the instrument that you're trading is, like Bitcoin spot goes higher. This means that the option value will go higher by that amount of the delta. But that should lead you to all sorts of questions like, what strike price should we pick? How far out in time? Is a week enough, or should we pick a month, or should we pick several months? How far out do we go? And when is a good time to buy calls? During a pullback or a breakout? What type of setup would be good for buying calls? Well, we'll try to get into a little bit of that. Long calls are the simplest strategy for everyone to understand because it mimics buying the long spot currency. So everybody quickly assimilates that and say, wow, this is a leveraged way that I can use less capital to accomplish the same or even greater results. But by far, they're the hardest strategy to make consistent money with. Most online sources will start you off by showing you how to buy long calls, and I think that's a big mistake. I'm going to do the opposite. I'm going to try to convince you not to buy them. There is not one professional trader that I know that buys long call options for a living. Most sell options instead because it puts the probabilities in your favor. Why go against that? So with that said, I'll assume that you're still unconvinced that you want to know any possible way to trade long call options. So let's get into a little bit of detail on that. So first of all, how much time should you buy? When you buy a long call option, how much time value do you need to add on there? Because every option has got an expiration date. They don't last forever, right? They're not like a perpetual futures contract that lives in perpetuity, although you have to pay for that. This is why we have to pick an expiration date. So since you know about how an option decays in its last month, remember that graph where things were really slow in terms of the options decay, and then as we got closer and closer, boom, it decayed down to nothing in literally no time at all. So it accelerates into expiration. You'll probably want to buy at least twice as much time as you think that it will make. So in other words, if you think that the move is going to happen sometime in the next 2 weeks, then buy at least a month of time value for that option. If you think that maybe sometime in the next month you'll get the move, then at least 2 months of time value is required. Now, what's strike price? Should you go in the money, out of the money, at the money? Again, this is so much more complicated than just buying the spot currency, isn't it? So out of the money options will be the cheapest options. So you may be tempted to do that, but they're also going to be the most sensitive to external variables like time decay and implied volatility crush. They also have the most time value as the component of their price. Out of the money options will be the most explosive. So you can come up with all kinds of examples about, wow, look at this. When we had this huge move here, if you'd bought this option and if you'd sold it up here, you would have made a 1,000% gain. So there's no doubt about that. They're explosive. But trying to come up with the exact right time and place to buy them is extraordinarily difficult. So they are the most explosive, but they're also the lowest probability choice. What many people do is actually go in the money somewhat. And a compromise is a 70 delta option. So you'll see on the option chain, if they do show delta, they'll show somewhere around a 0.7, which is in the money. And it's mostly intrinsic value. There's a little bit of time value with it, but very little. So it offers fewer unwanted side effects when you buy this option. It's generally going to track the underlying pretty close to that. 70% correlation to tracking the underlying point for point in terms of gain. But they're not cheap. They're expensive. Your loss is limited to the entire premium that you paid for the option if you decide to manage the trade that way. Now, what setup should we take this with? Should we take these on pullbacks or breakouts, or what kind of bullish setup should we take them with? What you have to avoid at all costs is implied volatility crush. Let me explain this for a second here. When an asset sells off like this in price, what you will have at the very same time is the implied volatility will shoot higher. Implied volatility is the implied forward move. If you have the price going from, in this case, maybe quiet and trending to all of a sudden trending to the downside, trending and volatile, then you're going to have much more expected forward movement because markets that are selling off are much more volatile, yes? And so the implied volatility is going to go sky high. So if you think that you caught the bottom of this as the price comes down to support and then rallies from here, what you'll find is that the value of that option, even though you time everything perfectly, and maybe you buy that call option right down here, what you'll see is the implied volatility will just crush the life out of this thing. So you'll get everything right, but your option won't make any money. Okay, so this is implied volatility dropping as soon as you enter the trade. So that is a bad scenario to enter in. So for that reason, pullback entries are especially problematic because the pullback itself tends to pump up the implied volatility. Breakout entries might be a better choice. So a breakout entry is something where we rally up and then consolidate very quietly. Things get really quiet. People get complacent. The volume drops off and then boom, up goes the next leg. And this sort of stair-stepping movement. And actually the implied volatility stays fairly low during the whole thing. And you don't have that much crush during a breakout like that. So breakout entries might be a better choice. So if we look at this chart of Bitcoin, we can look at some of the better choices. So like if we have a breakout from a range, this might be a better choice for a call option. It's easy to see these in the rear view mirror, isn't it? Right? So here's another breakout that didn't last for very long. And so more than likely, your option dropped in value during this time. And only if you bought enough time were you able to ride the back end of this. Here was a nice breakout from a relatively low implied volatility environment. So we wouldn't have seen that much of an implied volatility spike on this short little pullback. Now you would have seen a big spike here. If you try to buy a call option right there on this reversal, you would have seen the life crushed out of that call option. Same thing for here. You would have seen the life crushed out of that. You could get everything right and still lose money in a scenario like that. And of course, this also implies that you're trading these on an uptrend. You never ever want to go long call options on a primary downtrend or bear market. That's just going to be a bad idea. Again, crush will be your worst enemy for that. Everyone gets talked into trading long calls sooner or later. If you're going to surrender to the hype, at least put more odds in your favor. Now, I do want to show you this example here. So I just happened to show yesterday versus today. Just happened to capture an option chain for the calls for this. And so we can look at some of these values here, and you can see how price can actually move and how much it can move. So if we go at the money, yesterday, the price of Bitcoin was about 10,000, and we can see that our option was running for about $1,400 yesterday. Now we have had a fair amount of implied volatility crush with a 500-point move. And so that option that was going for about 1,400, if we go to today, is running about 1,450. Not that much of a gain really for an at the money option. Also, another problem is we're not going to be able to find a 70 delta option for that because we're just not getting much of a bid for some of these options that are in the money. There's just no demand for them, which is one problem with some of the crypto options there. It's just liquidity. This will improve in time. The other thing I want to show you, though, is if we go yesterday versus today, if we look at an out-of-the-money option. So again, you're going to be tempted to say, oh, let's go for these out-of-the-money home run options. It's a lottery ticket. So we're going to buy this option for maybe somewhere in the midpoint. Let's just say it's $70. We're going to spend $70 on this option at the $18,000 strike, which would certainly, if the price by expiration, which is in this case 30 August, which is about a month from when I'm recording this, if the price were to get up there, you would see that $70 basically be worth, say, $1,400. You'd see the same thing. You'd see the price maximize itself. You'd see it explode in value as the price gets up to 18,000 if it were to get up there. So in that case, yes, it's a lottery ticket. It can be explosive in terms of the gains. How likely is that to happen for us to see in the next 30 days an 8,000 point rally? Don't know. More than likely, it's fairly unlikely. So now we did have a 500 point gain between yesterday and today. So let's look at the value of that option that we bought for $70 and go to today. And guess what? It's barely moved. And a lot of this is due to the implied volatility crush, number one. And also what you'll find is as you study more and more about options, that you'll get your biggest movement in the option value when it's right around at the money. So these out of the money, even though they're less expensive and they can be explosive, for the first few points of the move, it's not really responsive way out of the money. It is much more responsive at the money. So those are some of our points for trading long call options. If you're going to do it, make sure you put the odds in your favor and make sure that you heed some of the caution that I shared with you in this video, that it is a low probability. It's a very explosive trade, but low probability. I quite honestly think that futures contracts are a much more appropriate and easier to trade or long substitute instead of trading the spot currency. Now let's get to our second application for trading call options, which is to trade short calls. So instead of buying to open the position, we're going to be selling it to open. Entering a short call option means that you sell to open that position, bringing in cash from the onset, which is surprising to some people. As soon as they enter the trade, all of a sudden they notice their cash balance has increased. It's also a bearish trade, which creates an obligation to sell someone else Bitcoin or Ethereum at the strike price that you sell at. As long as the price of the asset does not get up to the strike price that you sell. So let's say that we sold this call option at Bitcoin 14,000 because that's the recent high and the price is down here maybe at 10 or 11 or something like that. As long as the price by the date of expiration does not get up there, then your option will expire by the expiration date and your obligation is released, and then you can go on with your life. You have no obligations past that point. But if the price goes higher than your strike price that you sold at, which was again 14,000, then you must sell someone else Bitcoin or Ethereum at that much lower price. So you may have to sell it to them at 14,000, even the price may be up to 18,000 by then. So you have potentially unlimited upside price risk. So how does a short call option gain and lose value? So this is a little confusing for people when they first start to sell options. Now, it totally makes sense for the price of an option, in this case, a call option. If the price goes higher, the value of the call option goes higher. But when you sell an option to open the trade, it's the exact opposite. So let's pick on the $14,000 call again. Let's pick on that $14,000 call. And let's just say that this is, we'd love to be able to sell it for $291. The market makers will love to sell it to us for $265. Let's say that we can negotiate $270. Now, what happens if the price goes up by $1,000? So let's say today it's $10,000 and by tomorrow it goes up to $11,000. Well, more than likely, right? So that option is going to go higher in value. A long call option is going to go higher in value, and it's actually probably going to raise from 270 probably to about 425 or so. And if we sold this at 270, it would cost us $400 and something to buy it back. That means that we're losing value in that call option if we sold it. So if we sold it to open, we don't want the price to go up. We want it to go down if possible, or just sort of waste its time between now and expiration and expire out of the money. So if the price goes down, then by 1,000 points, then we can almost project this to be somewhere about maybe 180. So if we sold this for 270, and if the price goes down to maybe 180 for that option, because the price went down by 1,000 points, then to buy it back, we sold it at 270, we bought it back at 180. We've now made $90 on that trade. So if the price goes down, we can make money as the option seller. It may take you a while to go through these examples because you're going to be required to kind of think upside down. It's almost like flying inverted, where the control inputs do the exact opposite things as they did when you were upright. Now, the problem is that when we sell a call option by itself, we have unlimited upside risk, and that's unacceptable. So in this case, you can see this example here, even though it's on a stock, this is the premium that we receive. And this is what happens as the price of the underlying starts going above that strike price that we sold the call option at. It goes down by an unlimited manner. So no matter what you do, you never want to be trading with unlimited risk. And this is why we only want to sell call options when they're covered. Can you imagine being a landlord renting out property on land that you didn't own? What are they called? Squatters, right? Something like that. You wouldn't be in business for very long. A covered call means that we will only sell call options if we can cover that obligation with our own BTC. So in other words, if you sell one contract of Bitcoin call options, you better have at least one Bitcoin to be able to cover that position. To be a landlord, we must first own the land. And we're going to cover this trade setup in more detail in Module 6. I just want you to understand what selling a call option means. It's a bearish trade. It brings in income. We want the price to go sideways to down instead of up when we do something like this. So in the next module, we'll cover applications for put options. So we're going to flip this thing around. We're going to talk about put options, and then after that, we'll get into the very specific income strategies. See you there.